Hi everybody, Marco Carvalho here from businesscreditbuilders.org. Today's video, we're going to talk about how to get a loan to start a business with no revenues whatsoever. You have no collateral. What can you do? How can you raise capital for your business? Now, we're not going to be talking about credit cards in this video. We're talking about getting an actual loan that you can use to start a business. So if you're looking to start a company and you have no revenues coming in, this is the video for you. This is an actual guide for those of you aspiring entrepreneurs. You're looking for some capital, whether you need to buy inventory or you need to buy some equipment for your business, or you're just needing that cash injection. Let's talk about what your options are and what obstacles you're probably facing right now. So the biggest challenge you'll see when you're Googling and you're looking at all the different types of loans that you can get for your business, when it comes to traditional banks, when it comes to fintech lenders, which is financial technology companies offering loans online, or you're looking at online lenders, the biggest thing is they're looking for is you got to have a track record as a business. And that's the obstacle you're probably facing. You're just getting started. You have no revenues. And they all want you to be at least 2 years in business. They want you to be already generating $100,000 a year or more in revenue. They require documents, bank statements, and so these are the obstacles you're probably facing right now. Is I'm not up off the ground yet. I don't have a track record as a business. I don't have any revenue coming in. So how can I get money so I can actually start generating revenue, right? So in this video, we're going to talk about the reality of what is actually available for those of you who are brand new, starting your business, and you're looking for a cash injection. Obviously, the things I just talked about, like traditional bank loans, fintech lenders, online lenders, those are options that are preventing you from getting started in your business because you don't meet those requirements. So I want to talk about 3 other options for you that may provide you the funding that you need. So first, we're going to talk about the SBA 7A loan. As you know, the SBA has this program where SBA approved lenders across the country, they have to be approved by the SBA to offer this SBA 7A loan. The beauty of that is, why is that such an attractive program for those of you who maybe have a business already or you're looking to start a company, is the fact that the SBA backs that loan up to $150,000, 85%. So that 85% guarantee is if you, as a business owner, let's say you default, the bank, the lender that issued that loan to you is covered up to 85% by the SBA. So that minimizes risk. So that incentivizes the lender to want to offer that type of loan because they're backed by the SBA. There's less risk. If you're wanting $150,000 or more in funding, then that guarantee by the SBA goes down to 75%. That's the beauty of SBA loans, the fact, and there's many different SBA loan programs. Specifically for the 7A loan, I want to talk about that today in this video really shortly, and then we're going to get into 2 other ones, which of course is the microloan. That's another option for you. And third is a personal loan that you can use for business. I'm going to run through each one of these real quick and give you some resources of what you can do if any one of these look like an option for you that you're considering. What are the requirements? How do you find out which lenders to approach for a SBA 7A loan or even a microloan or even personal loan funding? So let's talk about this SBA 7A loan. This particular loan program, it's for existing businesses, but also can be for you as a startup. If you have a business plan, you have some projections, but the SBA has standard requirements for this, and then the lender that's approved by the SBA to offer this program, they also have their own requirements. So just because you meet the SBA standard requirements, there may be a lender, if you select an SBA approved lender, they may have other requirements as well because they're the ones actually lending you money. Keep in mind that with SBA, lenders use actually a pre-screening, which is called they use the SBSS FICO score. Now, this is a scoring service that allows them to assess risk for you as a business owner. You probably heard about this in other different videos, is the FICO SBSS score. Now, that stands for Small Business Scoring Service. That particular score is used to assess you as a business owner and the business itself. They just raised the score requirement. You have to have at least a 165 SBSS score. It used to be 155, now it's 165. That doesn't mean you're going to get denied or rejected, but if you have a lower score than that, more likely they're going to have a more manual review, more underwriting required. But I want to share with you on the next screen is how does this SBSS score works? What is it? Like, how do I know what my score is? And I'm going to go into that in the next slide. But what I want to share with you first is how do you find out what the SBA standard requirements are? So all you're going to do is going to go to the SBA website, sba.gov. You're going to see here right under funding programs, just click on that and you're going to see the 7A loans right there. You just click on 7A loans and you'll see this covers quite a bit about the 7A loans and am I eligible? And you'll find here right what the standard requirements are to apply for this particular loan and how to apply. Once you meet those standard requirements, then you're going to need to find a lender. So that you click right here where it says lender match. And this is what allows you to find what lenders are SBA approved. And you can use their search tool right here in the SBA and they're going to provide you one close to you, an SBA approved lender. Now, what I'd like to talk to you about is there are SBA approved lenders and there's also SBA preferred lenders. What I recommend to you is to make sure you align yourself with an SBA preferred lender. An SBA preferred lender is a lender that has meeting certain criteria with the SBA and don't have to send it over to the file over to SBA. So these allow you, these particular type of lenders allow you to have a much quicker process in getting your SBA loan approved and funded, etc. So I recommend an SBA preferred lender. There's some big banks like Wells Fargo that are preferred lenders, but keep that in mind when you're searching for a SBA approved lender I would recommend using a preferred lender so that way you're getting a more expedited process if you're going the SBA route. What I'd like to talk to you about now is the FICO SBSS score. This scoring model is basically FICO pulls data from several points to generate this score. You're probably thinking, I have a startup business, I don't have a business track record, I don't even have a business credit established, so how do I have a small business SBSS score? Well, if you don't have a business credit file established, they're also going to pull your credit report. They use the credit data for you as an individual business owner as part of their risk assessment. So even though your business may not have a business credit file established, you may have exceptional credit and still get a good SBSS score. So the first data point they use is the consumer credit report of the owner. The next thing they use is your business credit data. So they're going to look at your business credit report. So how can you improve your SBSS score is, of course, you want to have good personal credit and you also want to have established business credit. That's data they use and they pull that data, whether it's from Dun & Bradstreet, Experian Commercial, Equifax Business, or even the Small Business Financial Exchange. That's where they can pull data to compile this SBSS score. They're also going to use application data that you furnish on the application and your business financial data as well. But these four components make up your SBSS score. This score ranges from 0 to 300. Your score is going to determine whether a SBA approved lender is going to either want a more manual review process or you meet the criteria, which like I said is a 165 score range, to be qualified to move forward on the SBA 7A loan. This doesn't mean obviously that you're going to be approved if you have a 165. This is just the pre-screening they do. Now, if you're below the 165, keep in mind, that doesn't mean you're going to get rejected outright. They may want more review. You'll see right here in this chart, if you're in 0 to 140, for that scoring model, you're a high risk. So there's a manual underwriting process. Moderate is 141 to 164. 165, that's acceptable for SBA 7A loans. And then if you're higher than that, 230, 300, then you can expect a very fast underwriting process when applying for SBA 7A loans. Keep in mind, there's other criteria. This is just a benchmark indicator. It's a risk assessment tool, but it doesn't guarantee you're going to get an SBA 7A loan. All right, but this is what they use as a pre-screening. So I just want to make sure you're aware of this. If you want to find out what is my SBSS FICO score? Because you can't get that directly from FICO. You can get your consumer FICO score, but one of the only services providing that particular score, your SBSS FICO score, is a company called NAV. You can go to tradelinereporting.com. That'll take you right to the specific sign-up page. You want to register, and you can get access to your SBSS FICO score, what it is, so you'll know where you stand before you actually go out and apply for an SBA 7A loan. So this is, I know this is, there's a lot more information involved. I just gave you some guidance as to finding out what the SBA requirements are, and obviously what the pre-screening score, how to find out what your SBSS score is. And just keep in mind, you want to improve your personal credit because that's going to play a big factor in what your FICO SBSS score is. You want to build up your business credit. These are all things that can prepare you. And let's say you're starting your business, you're like, you know what, this is too much. I'm not there yet. I need to work on my personal credit. Or let's say you don't meet other requirements for an SBA 7A loan. Well, if in the future you plan to apply for SBA, this is going to prepare you for what you need to have in place. Okay, so you can build up your business credit, work on your personal credit, and maybe you want to approach a different loan option, which we're going to cover here next, to get you the funding you need to start your business. And then you could pursue maybe a SBA 7A loan down in the future when you have revenues coming in and you've addressed all these other issues that you may have on your credit, or you haven't established your business credit. So let's talk about another option, which is called the microloan. This is just what it's called, a microloan. It's a loan $50,000 or less. So if you're needing hundreds of thousands of dollars, obviously this won't meet your requirement, but the typical microloan is about $14,000, $15,000. That's the typical amount, but this goes up to $50,000. The requirements here, you don't have to have perfect credit, but you want to have at least a 650 or higher credit score, a business plan, because remember, this is a microloan. It's going to be used for your business. So the intermediary lender is going to require to see a business plan, most of them. So they want to see what's your projected funding that you're going to be able to generate in this business by us funding you. So they want to see also the use of funds. They have certain restrictions what the funds cannot be used for. You want to have your projections like I talk about, and a personal financial statement. This is kind of a quick rundown of what's going to be expected of you when applying for a microloan. Now this microloan is offered by SBA approved intermediaries. To find out the list of microlenders that offer this particular microloan, again, you're going to want to go to the SBA.gov website. You're going to do the same thing, go under funding programs, and you're going to see microloans. So click on microloans right here, and this is going to give you an overview of microloans. You can find out how you're eligible, and here are the basic requirements here, and how you can use this microloan, what do you need to apply, and then you can find a micro lender right here. So you click on that, and all you're going to do, you could type in your state right here, and it's going to list all the micro lenders in your area that you can go to and apply for, and you can check out their website to see what that criteria is, but this is where you can find your list of micro lenders offering this particular funding option. The next thing I want to talk about is personal loans. Personal loans you can use for business. Now this is, I would say, the least barrier to entry compared to the other two, because the two main factors that are going to determine what you're going to qualify for a personal loan that you can use for business would be your personal credit and your personal income. Now keep in mind, you're saying, well, this is for a business. Yes, it is for a business, but it's a startup business. So your business has no track record, no revenues. So the only risk assessment data that a lender can look at is you as the business owner. If you're managing your personal credit responsibly, then they see that maybe you're going to be able to manage your business credit or your business financing responsibly. And the next thing to look at is your personal income. Since the business doesn't have income, how can it repay on a loan? That it's going to rely on your personal income. So that's going to be your personal income is going to be used to determine how you can pay back on the loan you're going to use for the business. So those are the two factors: personal credit and personal income. And then finally is your debt to income ratio. That's a big factor on whether a lender wants to see if you can handle this amount of lending that we're going to extend to you based on your credit and your income and your ratio. So I want to break these three things down for you. First, you want to order your credit report. You see me share the screen many times on different videos. If you don't have access to your credit report on a regular basis, you want to have a service that does that. So I recommend knowmycredit.org. There's lots of services out there like Credit Karma, that are free. But the thing I don't like about that is the fact that it only shows you 2 bureaus and it's your Vantage score. It's not your actual FICO score. This particular service allows you to see all 3 of your credit reports and all 3 of your FICO scores, your consumer FICO scores. They have a promotion, $1 for 7 days. So you're going to go to knowmycredit.org. This is the website. And then it's $35 a month to have complete monitoring of all 3 of your credit reports and scores. You get notifications, identity theft protection. But that's the first thing you want to know is what is your credit, where does your score stand? So like I said, here with your score range, you know, on loan funding, you want to be above 670 at least. All right, so if you're below 670 on your FICO score, you're going to want to improve that when it comes to applying for loan funding. With the personal credit report, there's some things that are going to make some big factors on you getting declined for a personal loan. If you have open collections, even if they're small open collections, pay them off. It's better to have a paid collection than an open collection. If it's a collection that you want to have removed, then you can dispute it. I'm going to get into that in a second. Any late payments on there, especially if you have late payments on any installment loans that you've had in the past or loans, that's going to play a big factor because remember, this is comparable funding. Is your installment loan track record compared to getting a new installment loan. If you have late payments on a previous installment loan, then that's a red flag. So you want to address those late payments. Any derogatory items on your credit, recently opened accounts. Too much activity can also trigger a decline with a loan. If you have inquiries, now you heard me talk about our AI Credit Pro service. You want to watch this video here that goes into detail on our credit repair software. The software is completely free, and the only thing that's required though is for you to create your smart credit bureau monitor report. That allows you to import all 3 of your credit reports into the software. So you can go right here to our website, Business Credit Builders, and here's a demo video on the software if you're looking to repair your personal credit. That's the factors on your personal credit that are going to play a role is these particular items right here. The next thing we're talking about is your personal income. What type of income do you make right now? Because the lenders want to know, obviously, how much, the more income you make and the lower debt you have, the more you're going to be able to borrow. So employment, whether you have, the reason why I highlighted pay stubs is most lenders are required to see their past 4 weeks of pay stubs for verification purposes. If you're self-employed, you're looking for personal loans, then the lender's going to most likely want to see your tax return or even your bank statements. Rental income, if that's another source of income for you, and then you have, if you're on Social Security or pensions, there's usually a statement that a lender may require for you to furnish that as well. So verification of income is required by most lenders. That's your second most important thing. The third factor that you're going to want to look at, and I'm sharing this with you so you can kind of get an idea of you could do these calculations yourself. But what is your debt to income ratio, especially if you want to start a business, you want to get a loan, you want to first determine what's your recurrent monthly debt. So you total those up. You know, what are you paying on your credit card statements every month, or credit card bills every month? What are you paying for a mortgage or rent? What's your car payment? Those are the only things you want to add up. You don't want to add groceries or anything like that. It's just your fixed recurring debts. And then you have your gross monthly income. You're going to divide your recurring monthly debt into your gross monthly income, and that's going to give you your debt to income ratio, your percentage. Most lenders want to see you 35% or low as far as debt to income ratio. Some may go up to 40%, but the lower your debt to income ratio is, the better it is for you, because that means you can handle more in payments when it comes to getting loans. So that's a big factor. If you're above 40%, lenders are going to decline you because your debt to credit ratio is too high. So how do you fix that? Either pay off some of your debts or make some more income. But keep in mind, you're gonna have to provide proof of that income to qualify for more. So if this is an option for you, let's say you've done your ratios, you're let's say at 32% or 34%, your credit's decent, you're at 680 credit score higher, and you're saying, well, I want to get the personal loan funding. The other two, you know, I don't want to deal with, or it's going to take too long. So personal loan funding, we offer a way for you to maximize loan funding. So if your goal is to raise a maximum amount of loan funding. We go up to $500,000 in personal loans. Obviously, you have to be making some really good income, or you can use household income to qualify for even more funding. But we do cash term loans you can use for your business. These are low monthly payments, up to 7 years repayment terms. And you can pre-qualify for this in less than 2 minutes. And we do a soft pull on our website. It doesn't trigger a hard pull for you just to do pre-qualification. That allows you to know how much in personal loan funding can I get that I can use for my startup. So all you're going to do is go to businesscreditbuilders.org. That'll take you right to our website right here. And you're going to see on this particular top icon here, don't click this blue tab. You're going to go right here where it says Startup Funding. So click this button right here where it says Startup Funding. And that's going to take you to this particular form for startup funding. This is loan funding, maximizing up to $500,000. And this is the form right here to fill out. It's going to trigger Experian and TransUnion soft pull, not a hard pull. This allows us to do an assessment to see how much you pre-qualify for. And in about 24 hours, you're going to get a call from us. We're going to go over these funding projections for you based on the credit, the income that you provided. Now, when you fill out that form and you say your income, remember, you're going to have to verify that income if you want to move forward funding. So if you say you make $150,000 in income, you're going to need to provide, if it's W-2, you're going to need to provide pay stubs to show that, or a W-2s. Most likely pay stubs though. But if you're self-employed, you're going to need to provide tax returns to show that proof of income. So just keep that in mind. Verification of income is key. Now, we also do business credit card funding for those of you who are looking to raise other types of credit, but we're talking about loans in this video. And now for those of you down the road, you're saying, you know what, I definitely think I'm going to apply for an SBA 7A loan, but I want to build up my business credit. I'm working on my personal credit. Well, I definitely encourage you to check out our business credit building system. This allows you to build up your business credit, which of course will impact your SBSS FICO score for your business. So future, when you apply for an SBA approved loan, and keep in mind that the SBA approved lenders are not the only ones that use the FICO SBSS score. Lenders use it, even credit card issuers use it. And so that plays a big part for those of you who don't think that business credit, I'll just use my personal credit, or don't think that personal credit's important, I'll just build my business credit. They're both playing hand in hand, especially with a lender or a bank that pulls your FICO SBSS score, because that score is a combination of personal credit of the owners, it's the business credit data, as well as the information you provide in the application, and they also use other financial data of your business. So all those things play a role that can impact your company's ability for acquiring funding. So with that, I hope you found this information helpful on getting loans for your business, your startup. I want to wish you the best success. Give us a thumbs up if you like this video. Click subscribe. That way you're always notified when we come out with more videos about funding and maximizing your ability to get funding as a startup or existing business. Make it a great day. We'll talk to you real soon.